Hello, iBrokers. It is Bill Provost, and sorry I couldn't be there with you live today. I'm in the midst of doing continuing education today, so I was completely locked up. Sorry to miss y'all, but I did want to get a quick rate update. Of course, we're all seeing it. Rates are, really starting to, kind of kick up and have a significant impact here. And so I just want to kind of throw a couple slides together, kind of walk you guys through everybody. And so here we go, right? So first off, where are we today? As this slide shows, this is just a slide I pulled from CNBC, and it just kind of tracks 30-year fixed rates for what it's worth. These numbers also typically include points, right? But something in the low 7% range for a solid credit, solid down payment, a conventional loan, you're probably seeing something 7.125, maybe 7.25, depending on the day, maybe 7%. But that's kind of where we're hovering right now. So I know it's. I still remember when a couple of months ago when I told everybody it was over 4%. It was a collective gasp for air. I can only imagine how everyone's feeling now. But this market continues to be resilient. I mean, certainly right now, this 7% mark seems to be having a pretty significant impact, but we'll see what happens. So anyway, over 7% on conventional, FHA and VA a bit less. Jumbo still kind of hanging in there. I mean, I'm seeing jumbo. I priced one late last week in the low 6% range on a 30-year fixed. So that's noteworthy. So that's kind of where rates are right now. Next up, I thought it would be good to show a little bit of historical perspective. So this takes us all the way back to the early 70s when Fannie and Freddie were created. We all have seen this chart before, but it is just interesting to kind of look at. And I see my thumbnail for the video is kind of a little bit cutting off the corner there, but you can see, I mean, if you follow rates back to where we are right now, you have to go back to the late 90s and early 2000s to see rates kind of where we are at this very moment. So definitely up significantly. Again, the big driver is what the heck is going on with inflation. So that's a little historical perspective. Again, definitely higher than most people have seen that have been in the business for 20 years or less. But again, in a historical context, of course, we've seen rates deep into the double digits, and so we will survive this as well. One last slide I just wanted to talk about is like, geez, okay, is there any relief in sight? And so the relief is going to come from a drop in inflation. And what this chart is showing is it's actually showing about 16 months worth of month-over-month core inflation data. And so the number everybody pays attention to is the headline core inflation. And all that is the month-over-month from the previous 12 months just added up. Right. So what you're seeing on the far left of this is in the yellow, the last 3 months in the yellow that was a period last year where rates are actually on the lower side. And so those numbers have actually been setting us up for an increase in the CPI and the inflation data, which we have seen, right? Last month was a bit higher. The nice thing is that last read of 0.3% for September is now going to fall off for next month's data, and it's going to be replaced by a 0.6%. So as long as the month-over-month data comes in 0.6% or lower, which at this point is what all the experts are saying, we're going to see that CPI come down. And so I'm finally starting to hear a handful of people willing to kind of say that we could be at peak inflation right now. If that's the case, that should also mean we're at peak mortgage rates and hopefully can see some relief. The people that I follow that are much smarter than me are kind of thinking maybe even late this year and then early into next year, we could be in a position where we're actually going to see maybe some pretty significant relief on interest rates. So there hopefully is some relief in sight, but just kind of hold on and we will keep you posted as we move through this. Thanks for listening.